You are listening to Investing Matters, brought to you in association with London South East. This is the show that provides informative, educational and entertaining content from the world of investing. We do not give advice, so please do your own research.
Hello and welcome to the London South East Investing Matters podcast. Today I have the privilege of speaking with Annabel Brodie-Smith, the Communications Director at the Association of Investment Companies. She's an award-winning communications director as well. She's done absolutely phenomenal work enhancing the inflows and the education at the Association of Investment Companies. And she's been doing the work now at AIC for, is it around 23 years, Annabelle?
It's actually 24, Peter.
24.
I'm delighted to be here talking to you. It is 24. Yes, it's a very long time. And obviously, it shows that I find this industry fascinating.
Well, they've been blessed to have you, Annabelle. You've done so much in the time you've been there. And as I said earlier, you know, you've won some awards as well. You've picked up lots of awards from your fellow peers who've mentioned you, voted for you, and enabled you to get the recognition you deserve as well.
Well, that is true. And, you know, my aim is to ensure that the reputation of the investment company industry remains very good, but also I'm here to get the message out about investment companies, the message out to private investors, but also other types of investors too, and to explain really what investment companies are about and what the benefits are.
Absolutely. I want to start with, if I may, when I read this, I thought absolutely spot on. Okay. And this was only last week. And this was Mark Dampier. He's the former research director at Hargreaves Lansdown and the author of the Effective Investing book. Yeah. And he's also a non-executive director of 2 investment companies as well. Right. And this is what he wrote. I wish to shout out the Association of Investment Companies, the trade association that represents most investment companies. They are the SAS of the trade associations, a small band of passionate people who, as a trade association, should do tirelessly promote the attractions of investment trusts for investors. In particular, I want to shout out Annabel Brodie-Smith, who is the head of communication and has done such an incredible job for over 25 years in pushing attractions of investment trusts to private investors and the advisor community. Well, there you go.
I'm going to have to pay Mark later, aren't I? No. Incredibly nice and very kind and very flattering of him to make those comments. Obviously, you know, I'm a modest person, but it's always great to get that sort of recognition. It shows that somebody really recognizes what you're doing.
Yeah, and this is the thing. Every time we've spoken in the past, you're always very modest, very understated, but you're doing so much incredible work with your team. So this is why we're speaking again. And also because of the past 18 months or so, Annabelle, there's been an absolute flurry of retail investors plowing millions of pounds into investment trusts. And as Mark said in his article, this year alone, investment trusts have raised beyond 13.6 billion in new IPOs and secondary listings. So it appears that the investors, or retail investors at least, are really getting the message about the value and benefits of.
Yeah, it's actually 3.6 billion actually in raising new issues this year. In fact, in total, the sector's raised over 13.5 billion. So, you know, as I said, we've gotten over 3 billion in those new issues. But what's interesting is lots of our existing companies are issuing new shares. It's actually record-breaking issuance from those existing companies. And it does demonstrate there's really strong demand for investment companies which have faced up to the challenges of the pandemic and come through really well. The average investment company in the 11 months to the end of November is up 13%. And in fact, last year, again, we were up. You know, it was a volatile roller coaster ride last year, but again, the industry was up. So I think investors have really recognized that. And they're also recognizing some of our advantages, such as our ability to sustain dividends as a big benefit. And that's why they're coming to us.
Absolutely. So I wanted to start really, because obviously we're having this conversation. Your main focus is on educational content for retail, institutional and professionals. So I wanted to start really with regards to our retail investors in mind and talk about, first and foremost, what is an investment company and what's the difference between a trust and a fund for you, Annabelle?
Okay, well, an investment company is a company, it's listed on the stock exchange. So it therefore has an independent board of directors as it's listed on the stock exchange. Investors can buy and sell it. It's got a closed-ended structure. That means there's a fixed number of shares in issue. Whereas an open-ended fund is obviously not listed and it increases and decreases in size according to investors buying and selling. And that makes a big difference, particularly if we're talking about assets that are difficult to buy and sell, like, for example, property. Property open-ended funds had a torrid year last year, with most of them, in fact, suspended for the majority of the year, actually, because they couldn't sell their assets quick enough to give people back their money due to the conditions from the pandemic. Investment companies listed on the stock exchange, so you can buy and sell those shares. They continue to trade throughout the pandemic, throughout the tough times that property had. They, of course, suffered a share price, but then they bounced back. So I think that is a really important difference, the closed-ended structure, the independent boards of directors. It particularly makes investment companies suitable for these sort of hard-to-sell assets like infrastructure, renewable energy infrastructure, property. And also, because they sell at their share price, open-ended funds, you buy and sell them at the net asset value, the value of the underlying investments. Whereas with investment companies, you buy and sell at share price. So you would sometimes have perhaps a discount where the share price is lower than the asset value, the overall value of those assets, or perhaps at a premium where it's actually above, the share price is above the underlying value of the assets. I have to say the investment company industry has been performing very well. There's always going to be difference in the average discount, but the average discount is around 1% at the moment, which is pretty low if you look historically, but there's always going to be variations. So for example, the global emerging markets is out at 9% discount. The UK smaller companies is at 8% discount. And what that means is you're buying those companies and you're getting an 8% discount on the actual asset value, what the underlying assets are worth.
Indeed. I mean, we've seen the retail investors being attracted to it. And what's happened of late is, especially with the REITs and some of the logistics and warehousing sort of real estate investment trusts, they're sitting at a premium. Some of them are quite lofty, Annabelle.
They are.
Yeah. Do you have any concerns regarding that?
Well, that's one of the reasons why we're seeing so much share issuance in those categories. I'll explain, the growth capital sector, which invests in sort of later stage venture capital, very suitable, the investment company structures for that. It's been the best performer this year. It's up 47%. Similarly, you mentioned the warehouses. Obviously, with the boom in online shopping, need for warehouse space means, that sector is the second best performing, up 43%. So a lot of the companies in these sorts of sectors are issuing new shares to try and keep it sort of a lid on that demand. If they issue more shares, then hopefully that the idea behind that is it stops the premium getting so high. Because obviously if you buy at a high premium, and if that company then suffers, then it will have a sort of knock-on impact on your performance.
Indeed. And I saw that one of the most recent ones, which was quite significant, is it's a nice little niche that they're in. And in fact, because of the niche, they were able to grab the actual ticker for them, and that was Life Science REIT, and it took the ticker symbol Labs, which I thought was absolutely fantastic.
That's a really interesting company. It's a new launch, just launched now in November, and obviously, we've just been through a pandemic. Need for that type of building, that kind of the laboratory in the UK, and they've been out there busy buying on the market. I've seen them buy at least 4 buildings already, and it's a really interesting company.
Yeah, I mean, for me, dedicated property fund dealing with laboratories, pharma, biotech, and so on and so forth, for them to be able to go out and raise what was £350 million,
yes,
shows there's a need out there, or at least there's a demand out there, should I say.
There really is a demand out there. You know, as I said, we've seen a lot of interest in these sort of specialist property vehicles. We've also seen a lot of renewable energy infrastructure launches. So battery storage, solar, wind, all of those. We've seen a lot of money going into those. We've also seen some more general infrastructure launches. Pantheon Infrastructure raised 400 million. And then we've seen some really interesting companies. So, for example, you know, Seraphim Space investing in satellites and all sorts of space technology. Really fascinating.
It is. I mean, when we last spoke, Annabelle, we were talking about, you know, you and me being long-term investors, but some of the investments that are coming out now, I'm sometimes looking and thinking, right, okay, that's a bit different. That's a bit unique. And I think it was last month we saw Scottish Mortgage, which, you know, everybody's talking about. Lots of people seem to have that invested in. They buy, they put it in their portfolios and they forget, or they drip feed into it monthly and average in. And that invested in 3 blockchain companies, a fungus developer, a battery recycler. I was like, wow, you know, this is proper future tech.
I know. I mean, we have got the right structure to do that with this closed-ended structure. It's permanent capital.
Mm-hmm.
And what you're seeing is a trend, even with conventional investment companies, traditional investments like Scottish Mortgage, they are increasingly investing in unquoted companies. And, you know, obviously it's very innovative, but companies are staying private for longer.
Yes.
Particularly high growth companies. So for investors to get those opportunities, an investment company is the way to go about it.
I absolutely agree with you. So, with that in mind, then, when you talk about private equity, a lot of the private equity now are now, use the word, I'll try to be polite as possible here now, plundering the UK PLC and are coming and buying the private equity, the venture capitalists are coming and buying a lot of our entities. You know, Morrison's is the last big one to go and be taken over. Is there any concerns that there's going to be less and less for?
Well, this is a topic we've dealt with. I mean, the first thing is, I think it's important to identify the difference between these American, generally,
Yes.
private equity companies coming in. I think in the past, some of their practice has been dubious. You know, it has been too much debt being loaded onto the company. They haven't perhaps had the best long-term interests of that company at heart, for sure. I think you've got to differentiate between that and our investment company investors. For example, we have a private equity sector here in the investment company industry. It's actually performed very well. It's up 26% this year. And they are taking stakes and taking long-term stakes in companies and working with those companies and putting people on board to develop those companies over the long term. And I think you've got to differentiate between that and perhaps some of the practice we've seen in the US private equity companies. And we did actually put this very question to UK equity managers. And obviously, of course, it's having an impact on the share prices of some of the companies they own, which is positive. But they did have some concern as to the viability of this trend over the long term, because of course it does reduce the options for them in terms of what they can invest in.
That's a very important point, and I completely agree with you. There's a vast difference. There's a vast difference with the debt fuel stuff that's going on there. Annabelle, I want to move a little bit slightly across a little bit and talk about
Sure.
venture capital trust now.
Yeah, VCTs.
Yeah, VCTs, because a lot of people are moving into that. The importance of that and the benefits of that. Could you share that with us as well?
Oh, yeah. Well, venture capital trusts, I mean, for investors, they have very generous tax breaks. You know, you get 30% upfront capital tax relief if you hold that for 5 years. So upfront capital gains, 30% relief. I can actually explain that a little bit better. You know, your rate of income tax relief is 30% back straight away. You can invest up to £200,000 every year, but you must hold those VCT shares for 5 years to qualify for that income tax relief. Also, importantly, any of the dividends you receive are tax-free. And that makes a big difference. But I think the best thing about them, actually, and obviously those generous tax breaks are very important, is that they are investing in the UK's smaller, fast-growing, ambitious companies. And those are the companies that are going to grow and support the economy in the future. Interesting, we talk to venture capital trust managers all the time. They're seeing, not surprisingly, lots of opportunities in technology and healthcare at the moment, which makes a lot of sense. But those sort of companies have big economic and social benefits for the UK. They've been investing in these small types of companies, making sure they're strong through the pandemic, and they will be continuing to do that. So I think for investors, there's a great generous tax breaks, but they also have strong performance, and you are actually helping the economic and social benefits for the economy. So that they are very, very interesting investments.
Yeah, I think that says the same regarding the investment companies per se, really. And when we last spoke, we were talking about anniversaries and all the rest of it. And you've been going since 1868. So, a lot of these investors are long-term investors, which takes me straight on to the dividend heroes and explaining to our investors what they are and some of the strongest ones that have been going forward now, 50 plus years, some of them, in fact.
Yeah, well, this is actually very important. And again, it's a very important difference from open-ended funds, because investment companies have got a unique feature where they can hold back up to 15% of their income every year. They hold it in reserve, in the revenue reserve. And then when times get tough, and boy, did times get tough last year. We all know about that dividend drought, don't we?
Absolutely.
We all know about it. When times get tough, they can use this revenue reserve to boost their dividends. And that's the reason why investment companies with a dividend over 1%, last year, 85% of them increased or maintained their dividend, whereas just 23% of the equivalent open-ended funds did. So it's really, really important. We have 18 dividend hero investment companies, and 6 of those have been increasing their dividend every year for over 50 years. And investors find this incredibly reassuring. Growth is all good when it comes, but actually have the reliability of that income. It means a lot. And growth is good when it comes, but we never know when it's not going to come. And then at that stage, those dividends really pay off.
Absolutely. I mean, this is the beauty of compounding the portfolio and compounding the investments in the portfolio.
Absolutely. Reinvesting those dividends. Absolutely.
Can you highlight 2 or 3 of those dividend heroes for us, Annabelle?
Oh, yeah. Well, I have to say, City of London is really the ultimate dividend hero. It's in the UK equity income sector. It's managed by Job Curtis, who has been managing it an extremely long time. And he is a really lovely but incredibly reliable person. And it has been 55 years of consecutive dividend growth.
Bravo.
Okay, that's pretty impressive. We've got other, for example, Bankers Investment Trust. Again, that's in the global sector. I always smile because it's managed by somebody, the head key manager is called Alex Crook. But, 54 years of consecutive dividend increases.
He's banking those dividends. That's what he's doing. Yes.
Absolutely. So another Alliance Trust, again, a global sector, very, very long history that company's got. They've outsourced their asset management to Watson Wyatt, and they are multi-manager, 54 years. It's really worth, if you have a chance, go to the AIC's website. It's literally theaic.co.uk, and the Dividend Hero section is one of those sections that is really most used. People go and take a look and want to find out which of those companies which have got those long records. We've also got a lot of companies which have increased their dividends between 10 and 20 years too. But I think it's very reassuring to see those dividends rising every year.
Absolutely brilliant. That's really, really good for portfolios and for pensions as well. We've not mentioned pensions there.
Oh, for pensions, absolutely. And for people who are retired to looking to supplement their pension income, it's a great thing to consider.
Absolutely. So we've spoken about long-term investing a little bit. wanted to ask you, what's the current size-ish of the assets under management for investment companies that you have?
Oh, we're at an all-time high at the moment, 274 billion. I actually don't have the end of November data. I will do very shortly. Let me put that in context for you, Peter. When I joined the AIC, I think it was about 56 billion. That is 24 years ago. So it's nearly a 5-fold increase.
That is amazing. And when we spoke in June 2016, it was 165. So it's gone up another 109 since then.
Yeah, we've seen very, very strong growth. I mean, and a lot of that is just the companies performing well. We've had a particularly strong fundraising year this year. As you said, it's record, but a lot of that actually comes down to the companies actually performing really well.
Brilliant.
Investing Matters in association with London South East, one of the UK's leading share information websites for the private investor community, providing share prices, news and data straight to your desktop, tablet and phone.
Right, I wanted to talk a little bit, Annabelle, because you're obviously the communications director, but you're also a private investor in your own right, and you're investing long term. So I wanted to talk a bit about your investing style. Yeah.
Yes.
We're going to touch on diversification, but I want to touch on it with regards to your own investments as to what you've been up to and what you enjoy.
Okay, well, not surprisingly, Peter, my portfolio is investment companies. I do tell everybody you should have a diversified portfolio, but clearly it's what I understand best.
Yes.
And I'm getting that diversification, they're pooled investments with a professional fund manager in charge. So for me, it makes sense for me to have that. I have got around 15 or so, maybe just slightly more investment companies. I've got to say I am mainly growth focused, but I do have income focused investment companies as well. And it is just for that very reason that I think, the discipline of dividends generally, first of all, I think it makes managers perform well if they've got that discipline of dividends with them. But as I said, when things get tough, at least you have those dividends coming in and you can reinvest them, and it really gives you a boost. And my portfolio is predominantly equity, but I actually interestingly have 2 property investment companies. And I actually made a choice. I trade very rarely. But last year, I could tell, I thought there was a big opportunity and the market was very undervalued. So I invest in a property investment company, and I also invest in a UK smaller companies company. I am a bit of a contrarian. I love a contrarian opportunity. And normally that's when I trade, when I really think there's an opportunity, because I'm happy with my portfolio. I've selected, it's very balanced, it's very diversified. Generally, I'm happy with those companies. But if I think there's a real opportunity out there, that's when I will perhaps sell something and move into a new area. And in this case, I went for UK smaller companies and a UK commercial property company. And I have to say they have performed very well. So I'm very pleased with those decisions. Generally, contrarian decisions do perform well, but not always.
Indeed.
Not always. You've always got 1 or 2, I think, investments that you wish they were doing better.
Yeah.
Always.
Russia and Japan always seem to be on the cusp of and never really materialize.
Yes. And do you know what, Peter? I have to say I have both of those in my portfolio.
I think you mentioned them last time, to be fair. The thing I wanted to touch on here, Annabelle, and it's very, very important, is about the research element, because you're doing your research and you're picking up on contrarian opportunities and anomalies in the market. I wanted you to expand a little bit as to what you're looking for sometimes in the management of these companies, and also in the niche, and what you're looking for in thinking, actually, this is an opportunity here.
Quite often a manager change or maybe we had a lot of activity here in the investment company industry. We've got a lot of investment companies actually changing their management group. And this is a big advantage of the investment company structure. The board of directors is there to look after their shareholders' interests. So if the board are unhappy with the performance of the fund management group, then they can actually change the fund management group. We've had 6 investment companies change funds managers this year. And often a change of management group can present an opportunity. A change of manager can present an opportunity. So I always look for both of those. I obviously also am looking for something that's undervalued, so trading at a wider discount than the sector average for that sector. And there's normally a catalyst like a manager, or maybe last year they were just really undervalued. You know, the UK was so undervalued. Commercial property was obviously completely bombed out, haven't had a pandemic. And then I always look at the manager, and I do look quite closely at the manager. I look at their performance. If they're coming in to manage from somewhere else, I look at their performance under their other funds. I like to actually see them. I'm very lucky because I can actually go out and see a lot of managers, but you know, you go online, you look at videos. I like to actually see the manager, and perhaps if I'm lucky, actually ask him some questions, but I just like to see them before I actually invest.
Mm.
And I like to look at the gearing. We haven't talked about gearing. Gearing is an advantage of investment companies, the ability to borrow, to invest in assets. You know, if you think something's perhaps an investment opportunity, you can borrow up and invest. That's the whole idea behind gearing. And I like to look at the gearing as well. I think if an area is undervalued and it's perhaps a new manager and he's brought on board big gearing, you know, I think it does demonstrate some positive thinking from him. Of course, there's no guarantee it's going to work, but that's sort of my mindset. I also always obviously look at charges. I always look at charges.
Yeah, there's two things I wanted to touch on there from what you said. And I really appreciate that really full reply that you gave me there. Two things here: listening and reading and researching the fund managers, but also you said about listening to the videos and recordings that's done previously, but also possibly about AGMs, and then also
Yes.
about the charges. Obviously, it fluctuates between, but it seems to be coming down, which is of benefit to everybody.
I think it is coming down, actually. Do you know what? We've had 37 companies introduce changes to their charges this year,
Brilliant.
bringing them down to benefit shareholders. And that is a trend that's been going on within the industry. We're seeing a trend where people are getting rid of their performance fees. They're introducing tiered fees. So as the company grows in size, the shareholders get the benefits of the economies of scale. The charges go down as the company grows. So obviously charges are very important. I do think they are coming down. I think you're quite right. There was a second part of that question, and now I can't remember it. I was so busy talking about charges.
No, it's talking about the recordings of on the video, and also
Yes,
about
and the AGMs.
AGMs, about looking into the whites of their eyes, Annabelle.
I think, you know, this is a big advantage for investment companies. We are companies. You are shareholders. You can vote and have a say about the future of that company. You are part of it. And great advantage, again, is that you can attend the AGM and you can ask the manager and the board those questions that you want to. And I think that is incredibly beneficial. And what's great, there has to be some advantage of all the difficult times we've been through. But, you know, one of the advantages is now with technology, with Zoom or whatever it is, webinars, you can attend online. And I think that's just really wonderful. It's really opening up shareholder democracy, quite honestly, because it's really helping investors all over the country have a say in how their company is run.
I think has been absolutely phenomenal of late. And I think also, Annabelle, there's something here I'm going to have to give you credit for, which I don't think you've given yourself credit for, is that a lot of the investment companies are actually reporting and writing out actually what they've done fully. It's not a case of you scratching your head thinking, I don't quite get what they did there and why. They're actually writing out, and their communications have got so much better over the past 10 years.
Well, do you know, we have done our best on that.
I know you have. That's what I'm saying. I think that's why you should take credit for it.
Oh, thank you. We have done quite a lot of work on improving those communications. We actually hold awards, shareholder communication awards, the best, to try and encourage them to do better. Talking about AGMs, we've also just introduced this year an award for shareholder engagement for platforms, because of course more and more of us, me included, are holding our shares on platforms. And we want to encourage those platforms to engage and make sure that their investment company shareholders are finding out about the AGM, are finding out when there's an opportunity to vote, are finding out about any important, you know, corporate activity type changes. So we're encouraging that too, actually, for the platforms to do a better job. But yeah, those communications, I think you're right, they have improved, but there's always room for further improvement.
Absolutely. So with that in mind, Annabelle, I saw one of your managers won an award for communications recently. Emily, at Emily.
Yeah.
You're already nurturing the next generation to take
Yes.
your role on later on.
Emily, I was so pleased. He won a Rising Star Award
Yes, he
at
did.
the
Yes.
Investment Week Investment Company of the Year Awards.
Mhm.
And I have to say, Emily's just a phenomenal person, so dedicated, so passionate about investment companies. He has actually very recently left the association. He's going to work for 3i.
Oh,
A big private equity investment company. So really, really delighted for him. But of course, we're missing him.
absolutely. I'm just giving him a plug there and he's going away. Oh,
Oh,
dear.
I know.
Oh,
But he has been with us for 4.5 years, Peter.
bless him. No, brilliant. So, I mean, obviously, as we're speaking about awards, you guys won the Headline Money Press Office Team of the Year in 2019.
Yeah.
Highly commended 2019 as well. Thought Leadership Initiative 2018.
Yeah.
Headline Press Office Team of the Year 2013 and 15, all under your auspice as well. And tenure, you're doing pretty well.
Well, let me tell you, the thing about us is we are passionate about what we do. We are passionate about investment companies. We believe they are the best long-term investment actually for investors. And as a result, I mean, I think that inspires us to do good work.
Yeah, yeah. And I'm going to give a shout out to your colleague that's still there, Nick Britton, as well.
Oh, yes. Nick, I couldn't live without him. Could not live without him. He is my partner in here and his incredible support from him. And, obviously as a former journalist, just incredible writing skills and, absolutely great person to work with. Just so lucky to have him.
Absolutely. Your right hand, as we say. Oh, brilliant. Right. Annabelle, we're going to go back a little bit to your portfolio, your investing and all the rest of it. When we last spoke, you talked about your cost centers, and I want you to speak about your children and how that's going on. Have they got their own investments going? Are you encouraging them?
Yes, they've got their junior ISAs.
Yeah.
They've all got private equity, long-term investments. I've always been a big believer in private equity, actually. So, yeah, they've all got private equity investment companies. The cost centers are now 14 and 11.
Wow. Yeah.
So they're getting much older than they were.
Mm-hmm.
And, I think since we last spoke, we moved to the countryside.
Oh, wow.
We moved to Oxfordshire, which has been quite a difference.
Mm-hmm.
I'm commuting in 3 days a week now to the office. Mm-hmm. But no, the cost center's on good form. I'm very keen on financial education. I think it's very important, particularly for children.
Yes.
So I am, as ever, encouraging the cost centers to get to grips in terms of investing and their money and managing money. And, my eldest now, he's obviously got his own account. And it's interesting, the ongoing debate as to how much pocket money is enough and how you manage that. That's how you begin. You start to budget through that.
Absolutely. And giving the individuals, your son chores to do to earn the money and then
absolutely
how much to invest. Yeah.
And he will do that actually. So if I need some help changing the beds or something, if I pay him some money, he'll get up and do it. So that's good.
Brilliant. Now, I wanted to go back because you had a voluntary role back in, you did it for about 10 years as a trustee with Personal Finance Education Group. And you're also an active member of the Gender Equality Workstream for the Diversity Project.
Yes.
And an ambassador for Women on Board. So you're a very, very busy lady.
I am.
I want you to touch on, if we go reverse order, Personal Finance Education Group. Do you know what's been happening since you left?
Yes, absolutely. Now it has merged into Young Enterprise. They have a strand of work called Young Money, actually.
Yeah.
And again, their ambition is to give young people the skills and the confidence to manage their money properly. And they've been going out into schools, working with teachers to achieve that. And it's phenomenally good work. And it is so important. And I still cannot understand how little value we give to financial education in schools. Some of our work, and it is now on the curriculum, but, still it's so important because everyone is going to leave school. Everybody's going to be managing their own money.
Absolutely. So I'm working on a project now, and we're hoping to launch it fully next year, which is going to be around education of children and individuals regarding investing. So I'll tell you more about that.
Oh, wow. I really look forward to hearing about that.
Absolutely. And also, Annabelle, your other ambassador roles at Diversity Project and
Yes.
Women on Boards. So tell us a little bit more about that.
Well, I'm really passionate about diversity. I am really passionate. And quite honestly, the investment company industry has been changing, but there's much more work to do. Can I say, when I joined all those 24 years ago, I would think there was only about 3 or 4% directors who were female, literally. We're now up to 34% female directors.
Brilliant.
And that is something that is obviously increasing, but there's still a lot more work to do. There's a lot more work to do on other forms of diversity. And I am passionate about diversity because I think it does really deliver returns for people. That's the whole point of it. So Women on Boards, I've done some interesting work with them, helping encourage more women to consider becoming investment company directors. The Diversity Project, I've been doing work with them. That's actually encouraging, and this is really interesting, encouraging more young people, including women, to consider being fund managers. Obviously, there's a lot of work to do again when it comes to diversity in the fund management industry. The figures are around 11% female fund managers. They're very poor when it comes to ethnic diversity. There's a lot more we need to do. So it's something I'm really, really passionate about. And as I said, I think it delivers performance. That's what it's all about.
It does, and it goes back historically to what we've said as well. If we're thinking about females in investing or female investors, almost every single bit of research I've ever seen always says that female investors and female leaders perform better than the men. So there's a win-win there.
What's not to like about that, Peter? I mean, I couldn't comment, obviously, but I think we need more women in investments. That's for sure. We need more managers. We need more directors. We need more chief executives. We need all of that, quite honestly. So I am very keen to go out there and encourage young people and older people, quite honestly, to consider getting involved.
Brilliant. I'll be helping you, supporting you as much as I possibly can in that quest and that goal, Annabelle.
Thank you so much, Peter. Thank you so much.
But this is part of the reason why London South East have decided to put together this Investing Matters podcast, is about educating everybody as well. It's purely educational, which is why we're doing this.
Yeah, absolutely. Educating them about investing. Investing, actually, if you've got money sitting in a bank account, if you've got enough money to cover your bills for the next 3-4 months, you've just got money sitting spare. It's not working for you. You need to get out and make it work for you. And if you can talk to a financial advisor, that's great. But lots of us, we're in a position where we go out and we do our own research and we feel confident investing. And I think, the pandemic has really encouraged lots more younger people to consider and start investing. Isn't that wonderful? And obviously, we have investment company managers investing in cryptocurrencies, quite honestly. But, if you want to invest in some of the cutting edge technology that's around there, you need to look at the investment company industry. If you want to invest in conventional companies, you need to look at the investment company industry.
Absolutely. Now, you did a really important bit of research a while back, Annabelle. I want you to just touch on it a little bit for us. You did some research into investing at the worst times.
Oh, yes, I do remember that.
To share with us your findings here, because people are getting shook out and stuff all the time.
Oh, you're putting me on the spot now, Peter, because I'm not going to be able to remember the exact numbers. But I can tell you the reality is, if you invest in at the very worst time, just before the market crashed, and I think we looked back before the financial crisis, and you invested right at the height of the market, within 10 years, you would have still made a considerable amount of money, actually. And I think that's the most important lesson about investing. It is for the long term. And if you take a long-term perspective, then, the exciting ups and downs of the market shouldn't worry you, because you're there for the long term. You can take that long-term view. But yeah, that was the conclusion. Of course, if you invested at the market low, if you invested in last March, for example,
Which
when
you did.
yeah, then obviously you're going to perform even better. But, the time to start investing, it's time, not timing, in the market that counts when it comes to investing.
Absolutely agree, Annabelle. And you've been investing now for 24 years, so you've seen quite a few cycles already.
I have, most definitely. I've seen the tech boom and bust.
Of course.
Been through the financial crisis and now the pandemic. So yes, I have seen my fair share of ups and downs, quite honestly. And it's reassuring people to take a long-term view, to not panic when things get tough, let it ride it out. But, you look at your portfolio, does it meet your investment needs? If it does and you're happy with it, you leave it well alone.
Absolutely. Now, Annabelle, I've covered my questions. We've absolutely rattled through all of my questions, but I've got one last thing to ask you.
Oh.
Yeah, if I may, right? If I could be so bold. With regards to investing, for you and for all the investors, what should they be looking at? If they're calling themselves a long-term investor, what should be their minimum time frame within an investment?
We say at least 5 years, but I think personally, for me, it's at least 10 years.
Okie dokie.
At least 10 years. But I have to be honest, as I've confessed, I'm not a big trader. I do trade now and again, for sure. Yeah. I'm a great believer in regularly investing. You look at your portfolio, you've got somewhat an area where you think, that needs amending. I need to invest in that area. So then I will regularly invest every month in that investment company. But, you have to take a long-term view. Got to take a long-term view. I've been investing for my retirement, quite honestly. My SIP, my self-invested personal pension. So you have to take a long-term view. And as I said, for me, it's at least 10 years. But actually, for a lot of my investments, I've had for 20 or more.
Brilliant, brilliant. Annabelle, just lastly, if you just share with us, you've got a massive website and library of content. Where do investors that are interested in investment companies find your content to learn and improve?
They need to come to our website, theaic.co.uk. And we've got great information. We've got great data on investment companies there. You can do all your research there. But also, if you don't know much about investment companies, we've got great educational guides so you can read them and find out more.
Brilliant. Thank you ever so much, Annabelle.
Peter, it's been a pleasure, as ever. It's great to talk to you.
Thank you ever so much. That was Annabel Brodie-Smith, the Communications Director at Association of Investment Companies, award-winning spokesperson. Annabelle, been an absolute delight. Thank you ever so much again for being on Investing Matters.
Thank you, Peter.
Take care. God bless.
Thank you for taking the time to listen to Investing Matters. Be sure to check out the London South East website for free tools and info to research your next investment. You can also join in the conversation on our social media channels. And don't forget to subscribe to our YouTube channel for more content, including our CEO interviews. Catch you next time.